If you're thinking about buying a house this year or maybe even refinancing, here's one mistake that you need to avoid at all costs when it comes to your purchase or refinance. And it's making sure you file your taxes properly. I've seen this mistake happen countless times over my 15-year career where clients are making mistakes on their tax returns and it prevents them from becoming homeowners. So if this sounds like you, make sure that you watch this video to the very end. I'm going to talk about a few strategies that I think can help you when it comes time for you to qualify for your mortgage. First and foremost, the thing you have to be aware of is how many write-offs you are taking, whether you are self-employed or you're W-2'd. Making sure that your accountant isn't writing off a ton of stuff for you can help you qualify for a mortgage, because here's the thing. When we look at qualifying you for a loan, we are looking at your reported income on your tax returns. This primarily goes to all of my clients that are 1099, self-employed, independent contractors. You guys always come in and say, hey, I made $500,000 last year. And I look at your taxes and it shows you made 50 grand. You did not make $500,000. You had $5,000 of top line revenue, but that's not what you're telling the IRS that you are claiming as income. So one, make sure that you understand what your CPA is filing for you. So many times people are filing and they have no idea what a Schedule C, what a Schedule E looks like. They just know that, hey, I made X amount of dollars, or they think they made that amount of money. When in reality, what we look at as a mortgage lender versus what a CPA looks at are two different things. And what I mean by that is your accountant, their job is to limit your tax exposure. Their whole job is to look for ways, loopholes to avoid you paying more taxes, which then leads to a lower net taxable income, which means you typically get a higher tax refund, which all of us, with the way the economy is right now, who doesn't want more money coming back in the form of a tax refund right now? However, if you're thinking about getting a mortgage, that could bite you in the butt. What we look at as a lender is your taxable income. Again, I see this time and time again with our self-employed, independent contractor, 1099 people that are making good money. You're making great money, but your CPA is just too good at their job and they're writing everything off from your travel, your car, your cell phone, your marketing, and all this other stuff. And then you get back a $20,000 check. But when it comes time to buy your house, you can't qualify for a traditional mortgage. And so many of you get so frustrated and annoyed because you're making good money. And then when a lender tells you you can't buy a house, you end up not buying a house. You have to look at other forms to qualify, like either a bank statement loan or a DSCR loan, where as long as the investment property cash flows, you can get the financing on the deal. But you're not going to get the market rate today. So one tip I can give you is when it comes tax time and you're thinking about buying a house, talk to your loan officer and connect that person with your CPA. They need to work together to figure out what is the happy medium of you showing enough income to buy a house that you want and not getting killed when it comes to paying your taxes. This is something that my team has done year after year after year, because then we can really decipher how much money you actually have to show so you can qualify for a traditional mortgage. Now, if you don't care about qualifying for a traditional mortgage and you're willing to look at either a bank statement loan or a DSCR loan, like I mentioned, then hey, keep doing what you're doing with your accountant. No problem, because I can use 12 months of your bank statements and look at the deposits and use that as income to qualify you for your loan. So there's ways that we can be creative. However, for the most part, many of you watching this video want to qualify for a traditional loan. So the first mistake you need to avoid and you need to be aware of is making sure that you're not taking too many write-offs on your tax returns. Now, the other mistake I see many of you making is rushing to file your taxes because you're thinking you need the last 2 years of your tax returns in order to qualify for a loan. That is true. You do need the last 2 years. However, if you filed an extension, that's totally okay. We don't need that year's tax returns. Like right now, in 2023, we don't necessarily need your 22 returns to qualify for a loan. So this also brings in a situation. Let's say in 20 and 21, you made great money, but in 22, you didn't make a lot of money and maybe you even took a loss. That's going to affect you qualifying for your mortgage. So this is where, again, you have to know the caveats and what a loan officer is looking for to get you approved for the loan, because maybe you don't need to file those returns. Or on the flip side, maybe you had a bad 2020, you did a little better in 21, but you really killed it in 22. you'd want to make sure you get those 22 returns filed so that way we can use the higher income to help qualify you for your mortgage. So there's all these strategies that we're looking at as far as how to get somebody qualified for a loan. But if you're keeping your lender in the dark and not communicating with them, there's no way for us to give you the advice to make sure that you're doing the right things so that way you can qualify for a traditional mortgage. Now, again, if you don't care about the traditional mortgage, you can ignore this video because there's always going to be an option like a bank statement loan or a DSCR program that can get you financing. But that's not going to work for everybody. So make sure that you're paying attention to how many write-offs you have, what you claimed on the last couple of years versus where you are today. That way you can start to put your game plan together on what it's going to take to buy or refinance your house. And remember, once you get your house, you can go back to writing everything off or filing your taxes the way you need to. So that way you don't have to worry about paying more back to the IRS, because we all work hard for our money. And I get you want to keep as much of that as possible. I do the same thing myself every single year. So those 2 tips will help you avoid having to pay a higher interest rate, put more money down on a mortgage, and frustrate you about the entire buying process. Share this with one of your self-employed friends that can avoid this mistake and help them save thousands of dollars on their mortgage. And I'll see you on the next video.